Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. The investing world runs on numbers, but numbers, it turns out, are remarkably easy to manipulate. Not by changing them, but by choosing which numbers to show, when to start measuring, and also how to calculate an average.
We look at the statistical tricks that make bad investments look good, mediocre track records look brilliant, and risks disappear entirely. And in today's dumb question of the week, what makes a finding statistically significant? All right, let's get into it. So I have a bit of a love-hate relationship with numbers. I've kind of got used to them. You have to when you're an investor. But there are still some things that really annoy me. Like 51 is divisible by 17. Romin, that is disgusting. I wish it weren't true.
You see, I'm on the other side of that coin. I love numbers, and I always have.
But we can't always trust them, can we?
No, that's true. And I think if you kind of understand where they can be manipulated, you can interpret them much more effectively. So hopefully in this episode, we'll talk about ways people can get around those difficulties with numbers.
Now, you've done enough backtesting in your time to know how that process is not foolproof. And you can often trick yourself into thinking something looks beautiful and will always work.
Yeah, and I think people really get caught up in backtesting, and that's not a bad thing. So let me just start off by saying that backtesting is a beautiful thing and something we should all do. But the idea is you come up with an idea. I'm going to just buy gold, or I'm just going to buy Bitcoin. Well, that's maybe a good idea, maybe it's not. The only way you can really calibrate whether it is or it isn't is to look at history. Of course, history doesn't repeat, but it does rhyme. So it's really good to go back through these backtests and figure out what happened in the past. But don't get too hung up on the details. Now, what often happens is that people really get carried away with this, and they'll produce a really accurate portfolio where they've rounded it to the nearest basis point in terms of the allocations, and they'll think that that gives them an incredible guide to the future. Of course it doesn't. And usually what happens is the minute you implement one of these strategies, it tanks. And it's because of unforeseen circumstances. Quants will know this, quantitative analysts, because they always do this, right? They create a new fund which is going to harvest some new form of alpha, and then they go off, they launch the fund, their marketing department launches it, and then as soon as it's out, it tanks. So you won't be alone in this, but there are reasons why those go wrong.
I think any strategy designed with perfect hindsight is always going to be liable to this overfitting problem. There's a famous study in 2016 by Harvey, Liu, and Zhu, where they looked at 316 factors that had been published in top journals over the years, which had claimed to explain stock returns. And what they found was around 80% of these factors that were claimed to be significant, in fact, weren't significant. And most claimed research findings in financial economics are likely false, they said.
So even though it seems to be grounded in data, you can actually fool yourself. And academics can do this too.
This was called the factor zoo.
Oh, I like that. Sounds a bit like my book, The Financial Bestiary.
It's part of the problem that there's an incentive here on academics to try and find the secret sauce, the magic recipe, and they torture the data, throw loads of different variables at it. And obviously, if you do that, if you throw hundreds and hundreds of different scenarios at a window of the past, you're going to find something that looks like it massively outperformed, but it's more of a statistical accident.
And I think that's a problem, which is that historically there have been certain things which happen. Of course there have, which have boosted assets, particular assets, way above others. So it could be coming off the gold standard in the 70s. That, of course, unleashed gold, and it surged unbelievably following that huge macroeconomic change. And at the same time, not by coincidence, there was very high inflation. And ever since, people have thought, oh, well, gold provides a great inflation hedge, even though it probably doesn't. Or, at the moment, what's top of mind is oil shocks. And it could be that you do something which works particularly well in historic oil shocks, but of course, things were different then. The US wasn't such a large producer of oil, and maybe the UK was. So I think that's the difficulty with comparing with the past. If you overfit to these very idiosyncratic events, then you could end up with a not very good guide to the future.
And the point you made earlier that after publication, returns inevitably decay has been backed up by evidence. So there's a 2016 study from McLean and Pontiff, which found that if you extended the historical window that studies looked at, returns were around 26% lower than what was published. And if you looked at returns after publication, they were a staggering 58% lower. This is on average for factor research in investing.
And I always feel a bit like saying Father Christmas doesn't exist when someone comes to me and they say, look, I've just discovered this thing which is going to generate alpha. And you have to be a bit cynical about these claims because there is no secret source. That's the one thing I have discovered over a lifetime of investing. And if someone suggests that there is, well, you've got to question their judgment. So I think what you can take home from these back tests is you can wean out the ones which essentially are non-starters, which probably won't perform well in future, but just don't believe that the future will closely resemble the past because that's simply not going to happen.
There's another well-known phenomenon called look-ahead bias when you're doing backtesting, which is that you're building the backtest based on information that was not available at the time. So a classic, obvious example might be that you're using revised earnings estimates, and yet you're using them at the point in time where they just hadn't been revised.
Another more subtle one is if you interpolate the numbers, because sometimes the numbers don't update at the right time. So perhaps you filled in the data so that it aligns nicely. But if you do that, sometimes you can take information from the future and it bleeds into the past. So there are lots of subtleties here, which it's very easy to fall into those traps. Another really difficult one to avoid is including or excluding time series. Now, just by their nature, emerging market data series are shorter because we just don't have reliable data, or the data is irrelevant because there wasn't a stock market in China over the last 200 years, whereas there was in the United States and the UK. So there is a kind of bias there. And also, if you include an asset, then that by its very inclusion kind of biases the data set. It isn't possible to have a completely huge time series for every possible investment, and you have to be selective.
And the key point is that returns and drawdowns and risk might look very different over a 10-year window versus a 20-year window versus a 30-year window.
And another problem, obviously, is that there aren't that many 30-year windows which are independent. A lot of people claim to have really strong statistical significance when they're looking at 30-year windows. But in fact, what they've done is just look at overlapping 30-year windows. So it could go from 1970 to 2000, and then 1971 to 2001 and so on. But those are almost the same data. So that's why it's difficult to do these back tests when you're talking about investment careers. Usually we invest over a 30-year period when we're working, but there aren't that many 30-year periods which are independent that we can use.
And another problem, we're just listing problems with back tests. And poo-pooing all the work we do, is that data resolution makes a huge difference, doesn't it? Especially if you're looking at risk measures and drawdowns and things like that. If you're comparing two different strategies that have been published, and one is using daily data, and the other is using an extreme annual data, then the drawdowns are going to look much worse for the one with daily data because the fund might have recovered by the year's end. So you have to be careful what's actually going into these numbers when you look at the Sharpe ratio or the Sortino ratio or the max drawdown. All these things matter hugely.
I can see why people use annual data. It's just easier to fill in. There's less data to analyze, and it just looks cleaner. You can fit it into a spreadsheet reasonably. But like you say, the pain you feel is daily.
Yeah.
You don't feel annual returns. You look at the portfolio every day, particularly when there's a crisis. You shouldn't, but you do.
But to go back to the time window you look at, when you're actually looking at funds that exist out there and how they performed in the past, you look at their fact sheet. I think what a lot of people first look at is the return since inception. That's usually published. And that is, I would argue, the worst thing to look at. And the reason for that is the arbitrary time that a fund launches makes an absolutely massive difference to what the since inception return will be. And you could have two things that are tracking, the S&P 500. And if one launched at the bottom in 2009 and one launched a couple of years earlier, their since inception returns will look wildly different, but they're the same thing.
I think that's absolutely right. And I often hear people compare things that way. They say, look, here's the fund's return, and this is the other fund's return. They've got different inception dates, and one's massively better than the other. So you have to be really careful about those starting dates. Gold is one particular thing which always creates this huge argument. People say, oh, look at the returns of gold, it's unbelievable. But then when you actually look at the starting date, it was just after an awful crash for gold.
To be honest, I wish funds didn't even publish the since inception thing. I think it's so misleading. And it might be even more misleading than you realize because of the way the fund management industry works, where historically they've often launched loads of funds at the same time, sometimes not publicly, sometimes they incubate them, and then they see which do well over a year or two. Those ones keep going and become publicly available. The ones that have underperformed are sort of taken out the back and shot. And therefore, you end up with these like great looking funds, but it's just because there was always going to be one or two which did well.
Yeah, there is this survivorship bias, which you have to be really careful about. And I think some of the funds, it's not anything sinister. Of course, there's a commercial incentive to only keep the funds with a high assets under management number. Those are the most profitable ones. But certainly for active funds, there is this culling process, which tends to flatter the ones which have done well, and the ones which haven't done well just cease to exist or get merged into other funds.
And for a long period of time, I think people weren't really aware of this. And it really flattered the mutual fund industry, where the scale of underperformance by active managers wasn't clear. Now, the S&P Index versus Active report, which we often quote, adjusts for this and tries to look at all the funds that were active in the sample period, including the dead ones that got merged or shut down. And it's not a small effect, that survivorship bias.
And another report which I really like, which is very practical for an investor, is the persistence scorecard, which says, okay, we'll look at the best performing funds in a given period of time, and then we'll track those over the next X years. And if it's skill which is making them outperform, they should carry on outperforming. If it's luck, then the performance will degrade over time. And guess what? The longer the period you look at, the more it looks like luck. So I think that's really helpful because, okay, you buy a fund because it's outperforming historically. What else can you do? But then the question is, will that continue outperforming in future?
I'm pretty sure I looked at one of the Spiva reports a couple of years ago, and it showed that in the US equity fund sector, the top quartile of funds, not a single one of them remained in the top quartile over the following 4 years.
Yeah, that sounds right to me. And that's been a fairly persistent result from that persistent scorecard.
I also looked at various reports there have been over the decades into the effect of survivorship bias. And Vanguard's done some reporting on this. And around half the funds shut over any 15-year period. So it makes a big difference. And then there's various studies that have looked at, well, what effect does that have if you account for survivorship bias or don't? And it's something in the region of 1 to 2 percentage points per year of difference it would make to the annual return of the active management industry, which compounded over time is a huge difference.
And I guess in a sense, the effect is amplified because people chase recent performance. If you look at a fund that's done incredibly well over the last year, and I'm thinking about things like growth during that huge post-pandemic rally, when any growth-tilted fund did well, notably Cathy Wood's ARC funds, but also things like Scottish Mortgage and other Baillie Gifford funds, for example. And then these funds hoover up assets, they're talked about in the media, and it just amplifies this growth process. And eventually there's some day of reckoning and we get the big fall. So that was a tech wreck in 2022, for example. So I'd be cautious about using assets under management, look how big our fund is, to be a proxy for quality. That's not necessarily true. AUM could just be good marketing. And I think that one thing that Cathy Wood is very good at is marketing.
In fact, the academic research generally shows the opposite, doesn't it? When a fund gets bigger, outperformance becomes much harder.
Yeah, for the active funds, that's true because the opportunity set gets smaller. And this is one thing that Warren Buffett was always complaining about, which is that he simply couldn't buy a lot of the opportunities because he'd have to buy the whole company.
And the other thing that might be worth remembering is that the average investor in a fund does not receive the return of the fund because they don't get in at the bottom. So with the ARK-K example with Cathie Wood, she started with a couple of billion in assets before COVID. The fund peaked with something like $28 billion a year later, and then had a massive 75% drawdown. But over that period, the fund still had some positive returns, but the typical investor in the fund was in deeply negative territory because they came late to the party.
And that's when everyone was talking about the fund and all the excitement reached a kind of peak. And that's when most people get drawn in. So I think that's always a danger. Another one that comes to mind is Neil Woodford, who was incredibly successful when he ran this perpetual income fund as part of Invesco. Then he launched his own shop, Woodford Investment Management, and I think that's a fairly well documented disaster. And it's kind of interesting to think about why that happened. So he'd created this very successful income fund, but then when he launched Woodford Investment Management, there was a very different style that he adopted. I'd maybe characterize it as more growth oriented. I think he touted it at the time as something like a patient capital fund where people could invest and they'd get good capital return because they were willing to wait. And these small growthy type companies would pay out in future.
I think the key point was that the companies he bought were very illiquid. They were small, they didn't trade much. And when people started running for the door, he couldn't pay them back, or at least not quickly enough.
Yeah, that's right. So 20% of the assets, for example, were in AIM companies, which are much less liquid. And like you say, if you don't have gates on your fund, which stop people pulling out money, which are really prominently posted when people buy the fund, if you don't have those gates and you've got illiquid investments, then you can run into problems, as he did. And this launched a whole investigation by the FCA into this liquidity mismatch problem.
Every few years, investors get reminded of the problem with illiquid assets. There's a shakeout going on right now in private credit where it's grown hugely over the last decade. These are funds that make loans to private companies outside the bond market. And it's been seen as an alternative asset class with good uncorrelated returns. But people have started running for the door and the funds are gating. They were always allowed to gate and limit withdrawals to a certain amount each quarter. So they're just doing what they said they would do. But part of the reason these funds have been very popular, private credit, infrastructure funds, property funds, is that although they deliver over the long term quite similar returns to public markets, they do so somehow with much, much lower volatility. Now that's a number that might be the most misleading thing in this whole episode, that volatility number for private funds.
And this brings me to one of my favorite papers in finance, which is hilarious. It's written by Cliff Asness, who's this incredible quant. He's covered almost every topic there is, and he also runs many funds. And he makes a joke about taking one of their liquid funds and then marketing it as something which has this technology called Smooth, where basically they just ignore volatility. They only report it every year, kind of like private credit. So, of course, then it looks like it's uncorrelated with anything else if you only observe the price once a year. Furthermore, he's going to charge a 2 and 20 fee for it, 2% ongoing, 20% of the upside. Now, that's tongue in cheek, but it highlights a real problem with these private equity funds, which is if you buy something illiquid, you can't measure the price. It's very difficult to price a bridge or a shopping mall or a nuclear reactor.
Or a commercial loan. I'm not so sure they're that difficult to price. They just don't do it so much. Warren Buffett called it mark to myth, I believe, which I quite like as a framing.
I remember when we had the credit implosion in 2008, people were talking about mark to model, which just was a fancy way of saying we made the number up.
But you can see why pension funds and endowment trusts bought these kind of things in size was because their mandate is to deliver low volatility returns so they can fund something, fund some liabilities like pensions, like the running costs of a university or whatever. And so these funds that promised good returns with low volatility obviously look attractive. But as Cliff Asness says, not long ago, the illiquidity and non-marking that came with private investments was appropriately acknowledged as a bug. These days, this same bug is sold as a feature. But to be fair, we haven't had a major shakeout. It's the kind of thing I think might happen if we got a major economic downturn, possibly alongside higher rates, where you just can't keep the plates spinning.
If you had an energy shock, for example.
Yeah, anything that causes defaults to pick up and the money literally not to be flowing into the private credit fund.
But even then, I think another problem with these funds is the way they measure return. They use something called IRR, internal rate of return. Now, if you want to play with this, you can. In your spreadsheets, you can enter numbers for a fund, and then you can work out IRR using this XIRR function. So try this after the podcast. Open up a spreadsheet and work out the returns of an imaginary fund.
Roman, literally no one is going to do this, but carry on.
But the way you do this is to have an incredible first year where the fund triples, quadruples, quintuples in size. And then every year after that, the size remains absolutely constant. It doesn't gain any more in terms of return. And the IRR function just jumps on that huge initial return and doesn't really adjust it down much at all in the following years. Now, you're probably thinking, if you're a marketing person, well, there's probably a really good story you can spin based on IRR.
Oh, for sure. And there's a more insidious problem maybe with IRR, is that it can be kind of explicitly manipulated by delaying capital calls, because it's calculated really on when money is pulled into the fund. So what a fund manager can do is say, well, wait, we won't take your capital quite yet. You've promised it, but we'll take on some credit and fund the gap. We'll take the money later. And then you compress the window for the return on capital calculation, which makes the returns look much better.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Now, when it comes to financial markets and trying to outperform financial markets, everyone's looking for the secret signal, aren't they? Something overlooked where you can say, oh, it's ticked up. That means the stock market is going to tick up as well. But you have to be very careful of the fact that correlation does not mean causation.
Yeah, there are lots of classic examples of this. For example, yield curve inversion. This is one that gets trotted out regularly. But there haven't been that many yield curve inversions. Usually it's more to do with what the Fed does after a crisis. So during the crisis, they cut rates. After the crisis, they raise rates. And of course, when they raise rates, sometimes there's a kind of secondary problem. Or if there's an inflation spike and they raise rates, well, who knows what the cause of the sell-off was? Maybe the cause of the inflation.
And I guess there's a further issue there, which is just that recessions are an incredibly small sample size. I mean, how many has there been over the last 50 years? What, 7 or 8? It's hard to draw too many conclusions based on that, I would say.
Yeah, and there was a recent false negative for this yield curve inversion, and there was no recession at all in the United States, and stocks did incredibly well. So hopefully that'll reduce people's faith in that yield curve inversion thing. Often it's about what the Fed does. So when the Fed finishes a hiking cycle, stocks soar over the next 6 months. Well, sometimes they do, sometimes they don't. It really depends on the starting point and the macroeconomic situation when that happens.
But don't you love it, Roman, when you get a graph on Twitter or wherever, and they've got 2 lines going back 40 years, and they're completely irrelevant things, and they track each other really closely, and you go, oh my goodness, how does butter production in Bangladesh move the stock market in America? And you might think that's a crazy example, but apparently it's a real example. So David Lineweber, a mathematician, sifted through a UN data set covering 140 countries and found that, just based on statistics, butter production in Bangladesh alone explained 75% of S&P 500 variation from 1983 to 1993. And if you added in US cheese production and Bangladeshi sheep population, you got an R squared of 0.99, a near perfect fit. But this is the example of data mining, isn't it? How correlation does not mean causation, or that the lines are going to keep tracking each other into the future. You throw enough variables at it, you're going to find a match.
And of course, that's been compounded by the fact that people have now got AI and freely available data. Combine the two, and you've got these spurious correlation machines.
And people love it. We're pattern matchers, aren't we? Instinctively. And this mathematician said, reporters picked up on it, and I started getting calls from investors about the status of butter production in Bangladesh. And 20 years later, he's still getting calls. He's ruined his own life.
And some of these patterns have become folklore in investing. For example, sell in May and go away. That's one which people often quote. Or perhaps it's seasonal, so people will say there's usually a Santa rally. And there have been in some markets a fairly consistent set of Santa rallies, but is it going to be predictive? No, because it's not a strong pattern and it doesn't have any kind of grounding in reality.
Robin, you told us earlier in this episode that Santa does not exist.
I didn't say that.
He doesn't exist in terms of reliable stock market performance.
No, he's not a stock tipper.
Which brings us onto chart crimes, which are amongst my favourite mathematical lies because they're visual pictures. We don't have to do any algebra here.
And these are ones which really annoy me because, like you say, it's a visual thing, so we don't question it as much, perhaps. But it seems obvious when you look at the graph that something's true. At least that's the inference, the dodgy inference. Now, one I often see is truncated y-axes, or perhaps truncated x-axes, where they don't look at enough history. So if you want to make something look really big, you just zoom in and you don't place it in any kind of context. So when people talk about a bond sell-off, we're talking about tens of basis points usually. Yeah, it feels bad, but is it a huge sell-off? Probably not. Another one that people talk about is GDP growth. So they talk about growth collapsing. But when you actually look at the numbers and place it in context, it's usually not as bad as it's purported to be.
There's a famous statistician in the US called Edward Tufte, and he's created something called the lie factor around graphs, where it measures the difference between what we see as humans and what the data is actually saying. And a lie factor of 1.0 is honest, and anything beyond 1.05 is more and more misleading. And it's a particular concern when you break the y-axis, like you say, exaggerates the effect. And I'm not saying every graph has to start at 0, because that's not always appropriate. But a lot of the time you see it zoomed in way too much. And there's been academic research around this. There's a 2020 paper called Truncating the Y-Axis, Threat or Menace. And it found that just as people, instinctively, we lose our ability to assess the strength of a trend once the y-axis is significantly truncated. And crucially, adding that little squiggly break mark that some statisticians do on the axis to show that it's being truncated does not fix the problem at all. We ignore that.
And financial journalists do this in terms of their narrative as well. They'll often look at a sell-off and they'll say, look, this is the worst sell-off since 2020. To which I usually respond as I shout at my screen, so what? That's only a period of 6 years.
But it's the standard trick in copywriting to say it's the best day or the worst day since XYZ. And that point in time is usually 2020 or 2008.
Another one which is often misused is when you talk about percentages, because if you talk about changes in percentages, they can sound huge. People often talk about the VIX volatility index, and it's usually around 15%. And if it increases to, say, 20%, well, as a percentage change in that percentage, it's huge.
It's a 33% increase in the VIX. But it's not really, is it?
That's right. That's right. You should use something like percentage points, how much it's increased or decreased relative to that 15. 5 percentage points increase doesn't sound quite so sinister.
You can do a similar thing around GDP growth, interest rates, inflation, all of that stuff. Just listen carefully. Are they saying percentage or are they saying percentage points? Now, I feel we should dig into percentages just a little bit more to wrap the episode up, because I feel that this is the biggest place where numbers lie to people in investing, is that not all percentages and not all averages are the same. And I don't just mean mean versus median. I mean that in investing, by definition, over time, we're dealing with compound returns. And the typical way people would calculate a mean, an average in their everyday life is incredibly misleading when it comes to investing and will overstate what returns you should expect.
Now, it does make sense to use different return measures in different examples and different circumstances. If you're talking about long-term returns, people use average geometric return because that usually makes more sense. And if we're talking about compounding return, that geometric average return makes sense.
And you might see this referred to as the compound annual growth rate, CAGR.
And I think it's useful to get a really simple example that works through the differences. Let's say we take a 2-year period where in year 1, you lose 50%. In year 2, you gain 100%. Now you've broken even over those 2 years. So if you use a geometric average, that's what you see, a return of 0%. If you use the arithmetic average, you actually get a gain of 25%, which I think is misleading.
Oh, it's definitely misleading because you're averaging plus 100 and minus 50. But you need to account for compounding. And over the long term, it makes an absolutely massive difference. So if you look at the S&P 500, going back almost a century, the arithmetic average annual total return is almost 12%. Whereas the geometric average, which takes account of this compounding, is more like 9.8%. So it's a pretty big gap, like 2 percentage points between the two.
I noticed you used percentage points there, Michael. Well done.
Yes, we don't make any errors on this podcast.
At least not in the edit. Now, you can probably tell from that really extreme example, which made it massively different, that the bigger the shifts over time, the bigger the returns, the more volatile the investment, the bigger the gap, the wedge between these two different measures. So if you've got something with crazy volatility like cryptocurrency, maybe even emerging market stocks, you'd expect a bigger divergence in these two measures.
And things like leveraged ETFs as well. There will be a big difference here.
Now, that was a particularly nerdy point, but I think it's important that you do check what flavor of return you're seeing quoted. Fund fact sheets will normally use compounded annual growth rate, but if you look at stuff on the web, for example, or on social media, you should absolutely check whether it's the arithmetic average return or the geometric average.
And when you come to calculate the returns of your own portfolio, always tempting, isn't it, to use the arithmetic average?
Now, you'll notice in our newsletter, which we publish every Friday, which is completely free, we do have a table of returns, and we'll always use the compound annual growth rate. It gives a humorous introduction to markets, and it keeps you abreast of what's going on. If you want to learn more, you can sign up easily at pensioncraft.com/newsletter.
Okay, today's dumb question of the week. What makes a finding statistically significant? Because presumably what we're trying to do with any research, particularly around investing, is to say the variables we're looking at and the effect they have is that real? Is it actually influential? Or is it just happening due to chance and is therefore not repeatable?
So ideally, what we'd want is a metric that'll say, yeah, this could be random chance, or this is definitely true. This is a real effect. Now, historically, statisticians have used something called a p-value, where you assume there's no effect, and then you say, what's the probability of seeing data this extreme or more extreme by random chance? So critically, it's already conditioned on there being no effect. What it isn't is the probability that it's true or not. And you can think up these weird examples where you can prove with your data that it's both true and false. And this is ultimately what made me shift over into Bayesian statistics, which is a much more reasonable approach, where what you say instead is, given what I believed before and the data I've just seen, how probable is each of my hypotheses in the light of that new data? So in other words, it's the probability of seeing that effect given your prior beliefs and the data you've just observed, which I think is a much more coherent way of approaching it.
I mean, coming to this as a layman who hasn't touched statistics in any depth since my A-levels, those things you just said both sound pretty similar. I want to untangle them. So what I'll often see in the media in reporting around research findings, they'll say something like, this is statistically significant at the 5% level, which seems to be the convention and has been for like 100 years, where they're saying that if the p-value falls below 0.05, then there's less than 5% chance that this was just due to randomness or luck. And therefore, it's a statistically significant finding. And you reject that null hypothesis.
But notice that's conditioned on the hypothesis not being true. What you actually want, I'd argue, is to know what the probability of each of your hypotheses being true are in the light of your new data. Now, the Rubicon you have to cross in order to get that approach is you have to explicitly state your prior beliefs. And that's what a Bayesian approach does. It says, given my prior beliefs, given the data, what's my updated belief, my posterior belief, given that data? But you can see why most people don't become Bayesian, because it seems to be a more complicated answer. Whereas in fact, I think it's much more elegant and much more what people expect from the analysis itself.
I mean, the traditional approach around the p-value and the attempt to define statistical significance is that it's well known that there's a phenomenon called p-hacking, where if you test enough variables, eventually you'll find one that clears that 5% bar just by chance. So you found something statistically significant because you tested like 50 uncorrelated factors, and one of them is going to clear this bar.
That's just one example of many, many examples where p-values can just be reduced to an absurdity. So, I just really question any kind of analysis which I see with p-values. Now, we interviewed Sir David Spiegelhalter, who is an incredible statistician. He's a Bayesian, and he puts this really elegantly. He says, for example, that p-values are often misused as an all or nothing decision rule, i.e. significant or no effect, which he thinks is misleading. And that's because if you repeat the experiment, these p-values are unstable.
So it sounds like what we're saying is that statistical significance is not statistically significant in itself, which is annoying. But even if you found something genuinely significant, you cleared the p threshold repeatedly on studies, we're pretty sure this is a real effect. The other thing you have to remember is that most academic studies around investing and backtesting do not account for fees and do not account for transaction costs and taxes. So something that does outperform, genuinely looks like it outperforms, might not deliver that outperformance in the real world. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.